Welcome to our CFP exam prep discussion on related party transactions, specifically focusing on loss disallowance rules and the complex basis calculations that often trip up exam takers. Let's break down the core concept of related party transactions. When property is sold between related parties at a loss, the tax code disallows the recognition of that loss. This rule exists to prevent taxpayers from creating artificial losses while keeping assets within their family or business circle. Related parties include family members, corporations where you own more than 50% of the stock, and partnerships where you're a majority partner. Here's where it gets interesting and where many candidates make mistakes. While the loss is disallowed, it's not lost forever. The basis rules create a special situation for the buyer. The buyer effectively gets a split basis. For calculating future losses, they use the fair market value from the purchase. For calculating future gains, they use the seller's adjusted basis. This creates what we call a double basis scenario. Let me walk you through a practical example that commonly appears on the exam. Imagine Sarah sells a rental property to her daughter Emma for $400,000. Sarah's adjusted basis in the property was $500,000. The loss of $100,000 would be disallowed because this is a related party transaction. Now, if Emma later sells the property for $550,000, her gain would be calculated using Sarah's original basis of $500,000, resulting in a $50,000 gain. However, if Emma sells it for $350,000, her loss would be calculated using her purchase price of $400,000, resulting in a $50,000 loss. A frequent mistake students make is using the wrong basis for calculating subsequent gains or losses. Remember, the higher original basis only applies when calculating gains. For losses, you must use the purchase price basis. Another common error is forgetting that the disallowed loss isn't permanently lost. It's effectively built into the basis structure for future transactions. The exam often includes questions that test your understanding of indirect related party transactions too. For instance, if Sarah sells to her brother's controlled corporation, the related party rules still apply. Don't fall for questions where the relationship is obscured through multiple steps or entities. Here's a key testing point. The related party rules apply regardless of whether the transaction is legitimate or had a business purpose. Even if Sarah sold the property to Emma at market value, the loss would still be disallowed simply because they're related parties. When preparing for the exam, focus on recognizing related party relationships and understanding how the double basis rules work in subsequent transactions. Practice calculating gains and losses using both basis amounts, and always identify whether you're dealing with a gain or loss scenario first before selecting which basis to use. Remember this fundamental principle. The IRS wants to prevent related parties from recognizing losses while keeping assets in the family, but they're perfectly fine with taxing gains. That's why the basis rules are structured to ensure gains don't escape taxation while losses remain disallowed between related parties. Having a solid grasp of these related party transaction rules is crucial for the CFP exam, as they frequently appear in questions about tax planning and basis calculations. Focus on the mechanics of the double basis concept and practice working through multi-step transactions to strengthen your understanding.